Well, hello, hello, hello. Welcome to another party. One man party? Nah, it's a party if you're on the other end. Hopefully, you're enjoying this. Loved some comments. Would love to hear what anybody else is experiencing when they watch this. Is it too long? Is it too short? Is it too detailed? Is it not detailed enough? Is my BYU flag a problem? Um, anyway, feel free to give me any feedback, any comments whatsoever. Today I've got a few questions. I'm going to go ahead and jump into that. But first, quick introduction. Josh Thomas, mortgage broker here in Utah, helping people, Utah families with mortgages. So if you're outside of Utah, hopefully you enjoy the information, but I'm not going to be able to help you a whole lot. So yeah, feel free to reach out if there's ever anything we can do to help, but we are centered here in Utah. Okay, so I'm going to jump right in. I have a couple of questions that were asked this week that I thought were valuable to share in here. So first and foremost, somebody was asking me about moving from to be in between different states. So they have, or in the same state but different cities. So they have a house in Lehigh and they're wanting to buy a house in St. George and asking questions about owner occupancy. And their questions were focusing more on what the existing loan on the house in Lehigh and how it's going to treat what they do in St. George. So there are a few different ways that we can buy a home. When we buy a home, we're typically going to work with an agency. So the agencies, remember, Fannie Mae, Freddie Mac, FHA, VA, and USDA. Those are the 5 agencies that are responsible for 95% of the loans in the United States. If it's not one of those 5 agencies, it's probably what we call a non-QM loan. Non-QM means that it's non-qualified mortgage. These are all qualified mortgages, hence the term non-qualified or non-QM. Even non-QM loans in all 5 of these agencies, you can purchase a loan basically 3 ways, or purchase a house basically 3 ways. Owner-occupied as your primary residence, owner-occupied as a secondary residence, a vacation home, or as a non-owner occupied or rental property. Other ways than that, I don't know that there's really a way that exists. It's kind of a universe question, but as far as normal mainstream stuff, those are the 3 ways. And the question that's being asked is, if I buy a house in St. George and I keep my house in Lehigh, can I buy the house in St. George owner occupied? Because when I bought the Lehigh house, I bought the house owner occupied. And so this is the kind of the question, right? Does that make sense? The questions usually are asked on the deal on St. George, and I'll get into that as well. That's usually what people ask me about. But the question that this person was asking was, what happens to the house in Lehigh? Does that mortgage company have a problem or whatever? So it depends on when the house was, or when that loan was closed. So in this case, it was several years ago. They purchased and refinanced that home owner occupied. And as an owner occupied loan, they made an agreement. They signed paperwork that said that they're going to make it their primary residence for the next 12 months. Outside of those 12 months, free game, right? You can do whatever you want. But during the 12 months, it's owner occupied. So if they had just done this closing, say a month ago, or even 6 months ago as an owner occupied, then what they do on the St. George house matters. Okay. These guys in Lehigh may call that loan fraud. It's one of the top 2 ways that people commit loan fraud is owner occupancy fraud. I'm drawing a blank on the second way. Straw buyer. I don't actually know. I have to think that one through now that I've put myself on the spot in this live broadcast. But anyway, owner occupancy fraud is one of the top ways. And so if they had bought it, and or refinanced it recently, a month, 2 months, 6 months, something like that, then this bank may get wind of this new loan in St. George, and they may therefore do some investigation and find out if they think that they were guilty of loan fraud, then everybody gets implicated, right? And to be clear, loan fraud is actually considered a felony. So it's kind of a big deal. You don't want to get caught up in that. Obviously, most people, that's not their thing. And so they just need to know that that's a real boundary in the mortgage world. And then they're like, oh, I'll stay clear of that. But yeah, and this person was no exception to that. They weren't trying to get into any gray areas like that. Okay, so If it has been 12 or more months in Lehigh, then there's nothing. That property, that loan, nobody cares. They can do whatever they want because they already met their obligation of making it their primary residence for 12 months. Um, yeah, and there you go. Now, before I leave and go to the St. George house, which I'm going to do in a second, I think it's important to clarify that there are tax rules that get implicated, right? So if I'm going to live in this house and I'm going to move out of this house and move to this house, but I'm going to keep this loan and therefore turn it into a rental property. If I'm doing that, that's acceptable. That can be done as I just described, right? But what are the tax consequences? That's another question. And I think it's IRS publication 157. I think you type in publication 157 and it's called the primary residence exclusion. And it talks about the taxation. I'll save that for another day here in this broadcast. But just make sure you pay attention to that. Feel free to message me if you want me to address that sooner. Okay, on the St. George house now, if they purchased the St. George house, so this was also part of the question. The person's family was going to reside in Lehigh. The other person basically has worked down in St. George for a long time. And so the question was, can they make it their primary residence? And my question was kind of a counter question back was, is it honestly their primary residence? Because if their family still lives in Lehigh, I'm going to trust that that's still their primary residence. And this is not their primary residence. Now it's what's called a vacation home, right? It's a residence, all right, but it's a secondary residence. And for that person that was working in St. George, it's certainly a full-time residence, but it's not their primary even still because their family's still back home, right? And so, in the case of mortgage rates and mortgage programs, this program, if it's a vacation home or a secondary residence, second home as we call it, that has similar interest rates to rental properties, but down payments are much smaller. You only have to have 10% down, and you can go ahead and work on getting the financing. The interest rates, though, are very similar to rental interest rates in that regard. So, a 0.1% higher rates, give or take. Let's see. What else do I want to address with that? If his family was moving down with him, then clearly it's new primary residence. Those kinds of programs, we have even down payment assistance for that, or 3.5% down, or 5% down, depending on which program they're going to qualify for. So that's pretty normal, but 10% down on vacation homes, similar rates to rentals. One interesting piece is they have to be able to qualify for both mortgages. Now we can count rent. Because this is not going to be rented, this is going to be their family up here in Lehigh. Then they're going to need to be able to qualify for both mortgages in order to do that. On a vacation home, we can't count rent to help offset the cost of that. Some of our non-QM programs do allow for that. But not that. Pardon me 1 second. We are going to get an interruption, so I am going to pause this. How's that for an interruption on a live stream? It's a good thing I'm not super popular. Okay. So, vacation home, rental property. Rental properties, your minimum 15% down typically. So that's one of the cool things is vacation home. You do have to qualify for both mortgages, but it's still only 10% down, which is better. So I think that's about it for that question. Next question. I'm going to go ahead and show you something, assuming I can figure out how to do it. So I'm going to show you status updates. We do these for all of our clients. I got to figure out how to do it. There we go. Let's start with this guy. All right, all right. So you should be seeing our status updates. So we send these out on every single client. And why this would be interesting, I wonder if I can make it a little bit bigger. I can zoom. Yeah, there we go. We'll just zoom in even more. So every single client gets one of these. One of these days, I'll get this all automated, and clients will get these through the system. But for right now, it's still manual because I haven't come across a lot of systems that support this very well. But I'll go ahead and put in a client's name here and put in their address here, and then we'll start sending this out to all parties, both title companies, both sides, realtors, our client, if it's a refinance, just our client and title company, and any other parties that they want copied on this. But I kind of wanted to walk through because I think a lot of people don't realize all of the steps that are a part of a closing. So application received, somebody has to apply, obviously. Credit report reviewed and okayed. Those are some early steps, as you can see. Verification of housing history. We don't necessarily always need that, but at times we do. Sometimes we have to verify rental history. Or purchase history or ownership history if we do that. Verification of income, so pulling pay stubs, W-2s, verifications of employment, CPA letters, tax returns. There's all kinds of stuff that we do in that step. That's one of the biggest steps for sure. It probably deserves 5 or 6 of its own lines. Verification of assets. It's not just that they have assets, but are they all acceptable assets to use? Cash under the mattress, for example, is not acceptable in most cases. But we have ways around that. So if that's you, let us know. We can guide you through that. Proof of identification, options reviewed. So right up here in the beginning, we have a loan options. Like we show our clients different options that we go over. And the mortgage plan that we've chosen. We didn't choose it. You choose it. The client chooses it. But we go through and show in some pretty good depth all the different loan options you can qualify for, the corresponding down payments, interest rates, costs, programs, etc. And once we finish that step, then we go ahead and run an automated system. And as you can see, it says approval number 1 of 3. And so this is a big step to have your first approval. It's an automated system approval, or AUS. Fannie Mae and Freddie Mac both have systems called DU and LP or LPA. And these programs essentially go through and everything that you're looking at that I already mentioned, it kind of goes through and even pulls its own little background check and then just kicks back either an approval or a referral. And if it refers it, it's referring to a human underwriter. And we can still potentially close that loan, but there's new rules if it's referred. And then the next step is we send an approval letter. If you're buying a house, we send a pre-approval letter. And that email is extremely detailed with all of the stuff reviewed on this line here, as well as what documents we've received up above. If it's a purchase, we're also waiting for the purchase contract. So this is kind of the step where we are on hold, if you will, at this point. Oop, not the whole thing. Just this line is kind of where we pause and we're on hold while you're out there shopping for a house. The following after that is when you actually write an offer and the seller accepts it, and we get that purchase contract, or Rep C as we call it, real estate purchase contract. Then we will generate for you the official application and send disclosures to you. We'll lock in an interest rate. We will at that point call up the title company or email them, and we'll request a copy of the title report, which tells us, what liens need to be paid off and what other concerns there are, what judgments there might be. If we have concerns about somebody having judgments, we usually check that before approval number 1. But we have to go through the title to see it. So we clear that, and then we order the appraisal, and we get that back as well. Once we have all those steps kind of done, we'll submit your file. Actually, this isn't entirely true. So as soon as we reach this point, we typically will submit your file to underwriting. It's kind of shown in here, but it's shown a little bit differently. So we'll submit the file to the lender, and then we will wait to hear back from the lender. And that's what this step is once we hear back, that's called your conditional approval, because when we hear back, what they do is they conditionally approve that file. And so what that means is they've gone through all of the data from here down that we've supplied, and they've checked off certain things, and they've conditioned other things like, hey, on your pay stub, you're showing that they made 10,000 a month, and the way we calculate it, their year-to-date pay is only 8,000 a month. And so can you, give us more documents that'll evidence that or something. Anyway, so once we have that conditional approval, that is step 2 of 3, called loan commitment, conditional approval, submission underwriting. It's all kind of the same thing. Okay, and then we move on to the next step. So we usually will get that step, and then we get that title report back, and we get the appraisal back, and we don't wait for that approval, because frankly, most of the time those are just fine, and we already know how to deal with those without involving the lender. So we kind of overlap these 3 steps. Then we go through and we get your homeowner's insurance. We often will get that quoted right up front. Sometimes we have that in time for the approval right above it, but if not, we definitely need it by this point. Any other conditions that they asked for, we make sure we get those, either from you or the appraiser or whoever they're being conditioned from. And we go ahead and order our clear to close. So we ask for approval number 3 of 3. And, that's down here. So clear to order closing disclosure means that we release the closing disclosure is the loan estimate for closing. And so that's the stage that comes next. We get that sent out, and CD is what it's called in short. We provide that to the client, and then we go through with the client and make sure that CD is accurate. If it is not, then we get it made accurately. And once that's all done, then we basically go through and ask for final approval. So we get all the conditions that are needed, like as mentioned up here, and then we go right into asking for the final approval while we're getting that CD out. After that, we get our final approval, and we go ahead and order the closing documents, or we get cleared to order them. We order them and get them sent to title. Title is the third party in the state of Utah. Some people call this go to escrow or the escrow company. In Utah, we call it the title company, just because different insurance rules and stuff, it functions slightly differently here. But basically, we just call them the title company. So documents sent to title. We review the closing documents with the client. We go over them, make sure that they're exactly what we promised they would be up here, and they're what the client wants and needs. We're really heavy on our disclosures about money due at closing and monthly payments. So all the way back up here in the early stages where we're sending out the loan estimate, we're going to go ahead and this is going to be accurate, right? There's not going to be any drastic changes from there to here. But all the same, we go over it with our client before closing. Sometimes that's a hybrid closing that we're doing where the client's literally signing the documents, some of the closing documents online as we go over it. Let's see. Then we go to signing, what we call settlement. What most people call closing is actually called settlement here in Utah. And so we'll go and we'll sign the papers. Utah is a dry funding state, meaning that we will go and sign papers before all the monies are necessarily there at title. And when we sign the documents, it's not recorded yet. And so we have to sign the documents, make sure that everybody's happy, and then the funds will get dispersed and it gets recorded. Sometimes that's the same time, but sometimes it's not. Outside of Utah, some other states are wet sign states where the monies have to be there all balanced out before the signing can happen, because once they sign, that's it. It's recorded and it's final. But here we sign the papers first. So sometimes same day, sometimes the money's already there. It just kind of varies. And then it does hit that final step where all the monies are sent out, everything's recorded. We call that's truly called closing here in Utah. But because of the settlement, we typically will call it funding and recording. Funding means all the money has shown up from the lender, from the buyer, from anybody else. And then it's recorded that they're the official owner. So that's what a process looks like. Thought it'd be fun to take you guys through that. I had a lot of questions about this. This is probably one of our hottest buttons that people comment on is I ask them after closing how things went. They typically like that a lot. So I thought that'd be fun to kind of share that with you. So yeah, if you got any questions about it, just hit me up in the comments or whatever's easiest for you. I'm happy happy to answer that. Okay, moving on to the next question. So this one's interesting. This one, let's see if I can. So here's a client that paid $260,000 for a house that's now only worth $240,000. She's paying $500 a month for her renters to live there, and she just can't afford it anymore. So I talked about this recently about when somebody buys a rental property, the importance of watching the cash flow and watching the reserves, right? The cash flow and the reserves. And so if somebody's not doing that, this is the result. They can sometimes run into a serious headache. And so in this particular scenario, she's in a house. She's now upside down. She paid $260 for the house. Now she most likely had a down payment that went with it, but it's only worth $240 presently. So if she sells it, she's going to have to probably cough up some money for that. So again, going to the scenario that I was discussing before, where somebody has cash flow, they're aware of their cash flow, but also has reserves. This is part of the point to that. But she ends up going into a $500 a month liability. So she's renting the place out, but she's owing $500 a month. My question is why? Why did she ever put herself in this place? And so, but anyway, the question was, is there anything that we can do for her? I looked at it in depth. I don't see any refinance opportunity for her. She could potentially short sell it, where she talks to the bank that maybe she owes more than it's worth and talk to them about short selling. But she does have a couple other rental properties as well. And so with the equity that she may have in them, they may refuse to allow that. I'm not sure. And I don't know that that's going to be a good thing for her anyway. I also suggested that maybe she moves back into it, moves the renter out and moves herself back in, because then she is gone with a $1,500 a month loss. And I remember I realized, I imagine she might be living somewhere else. I don't know where that somewhere else is if she's renting. I had the impression she's currently renting herself, and so she'd get rid of that rent and and reduce that $500 liability, because now she's just paying the mortgage herself and removed her rent. So it was a kind of a tough one, but the main reason I thought that I would bring this one up is I thought that it was important to kind of rehash or retouch the value. If you're going to turn something into a rental, it's not just the monthly payment versus your rent that you're going to collect. You're never going to be able to keep 100% of the rent. The rent is the gross income, but expenses from the gross income are going to be things like repairs, vacancies, right? People move in and out sometimes, and there's days that, days, weeks, months where it's vacant. There's also other challenges along those lines. Like I said, repairs and stuff, that's probably the biggest one actually, but there's just maintenance that needs to happen on the property too. So you're never going to collect 100%. That's always going to be your gross rent. So you always want to look, and remember the agency rule that I was talking about is the agencies, Fannie, Freddie, FHA, VA, they're looking at a 75% rule. So they only count 75% of the rent, and they contrast that to the monthly payment. So if your monthly payment, let's say it's $1,500 a month, and the rent that you're collecting is $2,000, well, 75% of $2,000 is $1,500. That's a zero cash flow. There's no liability, but there's no income, right? That's a break-even loan. So in my perspective and watching people, that's a good deal. Okay, that's sustainable forever. It's not making any money, but it's sustainable because that rent's eventually going to go up. It's when you have money that you owe, like this lady. That's exactly what I was talking about, where you've got to know your cash flow and you've got to have a plan for that. And so in her situation of $500 a month negative cash flow and that $500 liability, you can buy a car for a $500 a month liability. I don't think you can get a super fancy car anymore with those, but man, for $500, I think I'd rather have a new car or something like that than a liability on a property that I'm upside down with. That doesn't sound very smart at all. So Um, yeah, and then the reserves. I talked about 6 months of whatever the monthly payment is times six. That's how much it's probably wise to have in reserves. But if I'm going into a property personally, if I'm going to buy a property that's going to represent a negative cash flow, $500, I'm probably going to trying to get it away from impacting me. Right? I don't want to wear that burden for years. Today's good, but how do I know tomorrow is going to be good? Right? And what if something happens tomorrow and I'm carrying into tomorrow a $500 liability from today? Oh man, that magnifies the problems of tomorrow. And so the way I like to look at it is if it's going to be $500 a month and it's going to take, let's say it takes 5 years until I think I'm going to hit the break even point. Well, 500 a month times a year is going to be $6,000. And then that's 5 years times $6,000. That's $30,000. So if this was me going into that transaction, knowing I'm going to have a $500 liability, I'm probably going to want to have $30,000 in a reserve account, and I'm okay counting that as my 6 months for the record, 6 months reserves. But I would probably make sure I had $30,000, and I just plan on peeling out 5,000 or $500 a month of that reserve, so that it doesn't burden me and my family. So my initial investment's going to have that extra 30,000, whatever I have to do on the down payment, plus that extra 30,000. Okay, I think that's probably about all that I'll say about that. So yeah, man, it sounded stressful to me when I listened to it. But yeah, how do people get into this? So that's part of the reason I make these videos, is so that people can hear some perspective and hopefully avoid some of these landmines themselves. So okay, let's see what else. Oh yeah, this is a good one. So this is probably where we're going to finish today. Um, Man, I don't know if I need to be doing longer podcasts or whatever these are called. But I just think when I'm at the gym and it's only a 20, 30-minute podcast, it's usually a little too short for my liking. I usually listen to those when I'm at the gym or driving. And I don't drive a whole lot because I tend to work from home a lot. Um, anyway, so sorry to those that this is too short. Feel free to weigh in on the comments and tell me if I need to make it longer, and I'll try to come up with more stuff. But refinancing a vehicle to have a down payment, that's the last topic I think I want to hit. So this one's cool. This one's actually a big deal. This one has a personal implication, as well as this is a question that came up last week. And so I want to go ahead and touch on that. So somebody's talking to me. They want to qualify. They live in a house. They don't really love their neighborhood. They want to get out of that neighborhood. They've got a little foggy, maybe 20, 25,000 that they've got saved up. They only bought their house semi recently, so they're probably not going to get a ton out of it. They might get another 20, 25 out of it, something like that. Let's see. Actually, I think that's the only down payment I got. I think they just started a business, and so they had all the rest of their money tied up in that. So 20, 25 grand is what they're going to get when they sell. And they need at least 30 in order to make this move. The house that they're looking at, the houses that they're looking at, the price points for those, they're going to need to be at least 30,000 out of pocket. And so they have a shortfall, a $5 to $10,000 shortfall. And it's really important to them to move out of this neighborhood right away and move into this new one that they're trying to do. And so as we considered, we were like, man, the only thing we could come up with, 401ks, IRAs, all those opportunities, they're not options for these guys. So they really do just need to muscle in and find another 5 to 10. Except as we're doing her pre-approval, we can see the debts, and she doesn't have any car loans. And so we asked her about car loans. How many do you have any vehicles? Because there's at least 2 of them. And of course they have car loans, but they're paid off. And I'm like, beautiful. That's what I kind of thought. So I don't know if you know this, but you can refinance a car when it's paid off. You can refinance it and take cash out against it. Same as a house, just way faster and way simpler because it's a way smaller loan. And they haven't made them super crazy complicated like they did car loans or house loans. So we actually recommended that she go talk to the bank or several. This is a time where you want to shop around car loans, HELOCs, even credit cards. These are the times that you want to shop around pretty long and heavy. Not necessarily long, but wide. Talk to several. Talk to quite a few. Um, I would suspect, and we ran numbers for her, I think it would have cost her around 300, 350 a month, something like that is what we were estimating to get a new car loan, but then it would give her at least $10,000 and she would then have enough money to make the down payment after she sells the other house. And she'd be able to make this move. So yeah, cars can be powerful down payments. What about that $350, Josh? You just talked about her buying a new house and having $350 additional debt besides the new house. So their existing debt isn't much different than their new debt's going to be. So that's part one. So it's not a big concern to them. The other part is they actually have almost no debt. In my world, we let you have additional debt besides the mortgage. But if you have no other debt, we still limit your buying power as if you do. So in other words, if you're going to buy a house costs $4,000 a month, we might be willing to let you have $5,500 a month of debt and still get the exact same house with the exact same house payment. It doesn't impact your buying power. You just have this extra debt that you don't have that you could have, and we'd still be okay with it. And the reason we're okay with it is because millions of homeowners have gone through, and when they have that extra debt, it's the same story as when they don't. But when this house payment's higher, then they have problems. And so we don't let that house payment go higher, even if they have no other debt, because consumer debt and house debt's treated differently in the public's eyes, I guess. So long story short, there's a little buffer of how much debt you can carry and still qualify. So it doesn't impact her buying power hardly at all. And she's able to then make the completion. This same story is my same story. This is how I got in my first rental. I remember wanting to buy a rental for several years, and my family and I were really good at getting out of debt, not really good at saving money. I don't know if I just get too complacent at work and I just start playing more than I should. But I don't save money that great. I get to a comfort zone and then I'm on vacation, I guess. But if you give me debt, I got a clear target. I can get that paid off pretty fast. And so at this point in my life, I had the desire to have a rental. I think we had $20,000 saved up, which is not enough money to buy a rental. And remember, this is my emergency fund, literally. You shouldn't necessarily follow my exact pattern here. But having a conversation with a realtor friend, and he's like, "You want to ever buy rentals?" And I was like, "Yeah, I'd love to buy a rental." And he's like, "What's stopping you?" And it's down payment. And he goes, "Well, don't you have your cars paid off?" And it was just like one of those moments where everything flashes in your mind in half a second. Like I saw the whole picture, and I just needed somebody to point that out to me. And so I immediately actually went and refinanced my truck, and I think I got $20,000 out of it. So I think I actually had like 30,000, 26, 28,000, something like that saved up. I was almost 30. So I think I got up to 50 so that I still had some money left over. And at that day and age, we had a special loan program that was only 10% down on a rental property, on a fourplex, actually. It was my first rental property was a fourplex. So how's that? Respect, right? I know some people freak out about having one tenant. I started with 4. That was my first. I've never had just one tenant. Anyway, so yeah, I went and got a truck loan. I immediately had the money. We immediately started going shopping. We found a fourplex and bought it. And this is back when the whole fourplex, I want to say, was like 300 grand. So we were only like 30,000 out of pocket. And I think I had 50 or something like that. And so anyway, that's how I got started. And so rental, my point in sharing all this is that we can sometimes refinance our cars to get the cash that we need for a down payment. So feel free to share that with somebody that you know. Share this video and tell them, jump to minute 30 or 34 or whatever. But sometimes people are holding themselves back because they can't see what I couldn't see. And I'm in the business, so no, if I couldn't see it, then how the crap can anybody else see it? Anyway, so I think that's about it. I think that's what we'll kind of wrap up with today. Yeah, trying to think of anything else exciting that's it's been happening. And just if you're seeing my other little videos on my social media channels, then you're pretty aware of all that. So Other than that, I will wish you well, and hopefully, if you're driving, you don't have much further to get to where you're going. And if you do, then hopefully you find something else good to listen to. Anyway, catch you later. You have a great rest of your day.